Good morning, everyone. Rashmi Shah here from Simplicity. Thank you for joining today on the webinar. I appreciate your time. Uh, Before I start, a few disclaimers that this webinar is for Indian residents and people living in India, and this webinar is not any investment related advice or talk, is not for people living in North America. Um, and I'll be talking on concepts and general what is happening. I won't be answering any questions on specific stocks. Um, at the end of the webinar, after 20 minutes or 25 minutes, you can I'll answer the questions which you put on the text on this YouTube channel. And thank you once again. And I hope you all had a very nice week. So today I'm going to talk about timing versus strategy. Which is more important in wealth creation? Is the timing the market more important or a strategy more important? I'm sure this question we all get every day in our mind, and most of us think that timing is the most important. Now, the reason I chose this topic because we never know what is the bottom of the market and what is the top of the market. So you can go wrong on the timing, but if you have a strategy, you can control the impact of the timing, and that is the objective, and that is the way I look at it. And I'm going to explain you how this happens with the real examples, real case studies, what we experience at Simplicity in our clients' accounts, and what have I experienced in my lifetime. And I'm sure you'll have a lot of questions, and feel free to ask me. Now, as we all know, the year 2020, none of us are going to forget that year in our lifetime. The world economy got hit by Corona tornado, correct? Like an earthquake or tornado happened, and the world economy got shattered in the month of February and March. And I don't think there's any business in the world which didn't get impacted. Every individual, every business, every country, every society, every person got impacted by that. So we all got opportunity in last 2 months to think, how do I rebuild my life? How do I rebuild my business? How do I rebuild my investments? So that it's a good time to think about it. How do we do that, correct? Timing or strategy? So let me explain in a different way. Let's say this picture I have taken from a city of Iowa in Ohio, state of Ohio. So there was a tornado which came in 2018 there, 2019, and see the picture before and see the picture after. You can see that. See this, the soda factory here, and see the soda factory here. So soda parlor there, correct? Sorry, not factory. You see what happened to that building. So you see what happened. Now, same thing happened to our portfolios, correct? Before the coronavirus came, most of us were getting 10 to 20% returns, depending on the timing of investments and the length of our investments. But after this coronavirus, in the month of March and April, the returns came down to from 4% to minus 15%. So the impact. So now, how do we like these guys have to rebuild their city and town? We have to rebuild our portfolios. So what do you do that? How do you structure that? Where do you start from that, correct? So that's the way I look at it, correct? That's the way I look at it. And none of us could have ever foreseen that in 2020, February and March, this kind of global earthquake or global pandemic was going to come and hit our portfolios. So now, what is the portfolio rebuilding strategy, correct? So portfolio rebuilding strategy is, there are some challenges. What are the challenges? Common challenges and main challenges. So the common challenges are economic uncertainty, investors' expectations, changing regulatory issues like SEBI keeps on changing, RBI keeps on changing rules out of a blue, and then the main challenges at our end is, so these are macro challenges and the micro challenges. Every person behaves differently. Then global trends and geopolitics happen every month, and what happens to the asset allocation strategy. Now, emotions. So these are the key challenges which we face. So as an advisor, my team at Simplicity, when we talk to a client, or when we work on our portfolios, we have to anticipate all this thing and keep in the back of our mind that these things are going to happen, and accordingly we have to advise. So we have to keep in our mind there is always going to be an economic certainty. The world was never perfect, it's never going to be perfect, but it's going to keep on improving. The investors always want the highest return. Nobody is now what you want, correct? The expectations. So you have to work with the client's expectations, and then you see the regulatory changes, correct? So these are the common things which we have to look at while working on the portfolio. So now, how do we address those challenges? So how do we address those challenges, and how do we come out of it, correct? So the key thing, what we do is, there are 4 things which impact clients' portfolios. The 4 things are, what impacts your wealth? There are 4 things which impacts your wealth. The number 1 is the strategy. The strategy, vision and strategy. If you don't have a vision and strategy, it will have the maximum impact on your portfolio. The second impact is your personality, how you think and how you behave, and how the advisor behaves, correct? So the personality of the advisor and the investor or the client, and if the person is investing on his own, his personality is going to have a very big influence on the portfolio. And the timing. Now, timing does have an impact. And the 4th thing is, what is the process he's following? What is the process of discipline? Like, are you doing exercise 1 hour every day, or you do 5 hours a week and only on Sunday, and you don't do any exercise? So it depends, or you do random, correct? So the health also depends that way. Now, if you do on a disciplined, regular way by following a process, your health is good, correct? So this is same thing about investments. So how do you do that? So what are the weights? So if the total return what you get, 40% is impacted by your vision and strategy, 15% is impacted by time, 20% by personality, and 25% by processes. So this is what experience. So I've been in this field for 40 years, and this is what I have experienced. Now what we can do is, the timing and personality, the negative impact of this too can be covered by having a proper vision and process. So if you take care of that, you can reduce that. So I'll go in depth and give with real examples. How do you? So when you do investments, when you build a portfolio, you have to look at this. What is your vision and strategy? What is the timing you're going to follow? What kind of personality you have, and what is the process you're going to follow? So vision and strategy. And now the most important thing in vision and strategy is following a proper asset allocation. Unfortunately, I have been living in US for 20 years, and I have worked in US, I have worked in India, and I have seen that people in US follow asset allocation strategy in a disciplined way. In India, people go with the highest return strategy. They focus more and flavor of the year, correct? So a couple of years back, real estate was very popular. Everybody went heavily loaded on real estate. Then equity or stocks or debt funds, so they go with the flavor of the month, correct? So everybody goes flavor of the season, and they don't follow proper asset allocation strategy. That's I have not seen in developed economies. In emerging economies, I have seen this trend. So again, within the asset allocation strategy, what is the sectors or which economies you're investing? In India, everybody is investing 100% in Indian economy. Now, what is the process you follow to create a large corpus? So your vision and strategies, you have to think, what do I want from my investments? Why I'm saving this? What is the objective? So they say, okay, my objective is number 1. I'm going to invest only in 5 or 6 sectors. I'm going to invest only in 10 instruments. I'm going to build a corpus of 1 crore, 5 crore, 10 crores, and this is the objective I'm going to do. Invest in sectors which are going to change the world. So these are some of the strategies you follow. So this is futuristic related, but most of the people look at the past. Okay, last 5 years, what gave the highest return? They invest there. History never repeats. Please. So, but most of the people go by past track record. Past track record does not reflect their future, correct? So what I did at the age of 20, I'm not going to do at the age of 40, and what I did at the age of 40, I'm not going to do at the age of 60. Same thing about investments. It changes, correct? It changes, but we, as a human beings, we have emotions, and we go by past track record and we invest. That's another philosophy I've seen which is incorrect. The safest way to protect your investments and wealth when this kind of global event happens is by following a proper asset allocation strategy. Now, what I mean by asset allocation strategy is you have a certain portion of money in your cash, which is reflecting next 6 months of your household expense. Then you have certain portion in bonds, certain portion in equities. And within equities, how much is in India, how much is in US, how much is in US, Japan or China, that way, within the asset class. Now, if everything is in one, you're living in India and you're investing everything in India, it will be bad, correct, when this kind of stuff happens. So what I have experienced in the last 1 year, the clients, so Simplicity has about 800 clients, and the clients who had a high allocation to US equity got less impacted by coronavirus. The clients whose portfolio were more global, they got less impacted. Now, that's what I've seen in the data, what we got. Now, we all have personal biases also. When doing a strategy, you should not have any bias. Think very clearly and rationally and build a portfolio and rebalance. So I'll give you another example. So we have a client who's from Singapore, Indian family working in Singapore, and we rebalance their portfolio every year in the month of April. Now, he has a equity allocation of 40% and 60% in debt, and he maintains it. So up to last 4-5 years, his equity was doing very well. So he was booking profits in equity and increasing allocation to debt. This year, in April, because the coronavirus, equity went down, correct? The stock markets went down, his equity went down, and he on himself called us and he said, I want to make it again 40%. I said, okay, are you aware of the risk? He says, yeah. That's a risk capital, and I want 40% always in equity, because and he's a senior gentleman, and imagine that kind of maturity the person has. Those portfolios do very well. Those portfolios with help. So this is the strategy we need to follow. Now, if you are young, your equity allocation should be 70-80%. At my age 60, I should be having 60% in bond and 40% of equity. Now, my personality is a little bit aggressive, so I have higher allocation to equity, but you need to always have certain portion in cash and in bonds to protect against uncertainty events, correct? Then other thing, I have seen other trend which I have seen in the strategy and vision, that investors are in last few years, correct? In last few years, global trend I've seen that there are only two kinds of companies the investors are rewarding. One is companies which are doing innovation and are disruptive, and the other is companies with zero debt and they are global scale. Now, you need to have a high allocation to this kind of investments. Now, you take, for example, Nasdaq today. Nasdaq today has already gone higher than what it was on January 1st, 2020. It's already 2% higher. So all the impact of this lockdown, closed down, so many people died in America, all that has been negated, and it has recovered fully. It has bounced back almost 27-28% from the bottom. And why? Because of innovation and technology, correct? And the other companies which have bounced back are all zero debt companies. So in India, Hindustan Lever, Nestle; in America, Costco, Starbucks, all those kind of companies have bounced back sharply. So investors are, so we need to have a higher allocation to this kind of stuff. So going forward, the same thing is going to happen, because now what has happened in the world, that there is excess capacity everywhere, and 15 to 20% demand, which for the current year has been deferred or postponed to next year and year after that, correct? And those companies which have borrowed heavily may not be able to sustain that, and they will go under, they will go bankrupt, correct? So who's going to take over them, or who's going to buy those assets? All these cash-rich companies, they will dominate that, correct? So investors are rewarding those kind of investments. Now, that's the reason small cap and mid cap are underperforming. Small cap and mid cap are the companies which are just starting and have a very small market capitalization. So they have, most of the small cap and mid cap companies have a lot of debts because they're small. They need loans, correct, to grow. So those companies, they're underperforming, and they are going to continue to underperform unless they have very good technology and innovation. So that is the other trend we are going to see. Then, so when you're building a vision or strategy, you need to keep this kind of thing in your mind, correct? What are the new trends? The consumer spending habits have changed. So previously we used to go to the mall. Now the supermarket has come home. The food and every destination, and also we used to go to mall to buy lifestyle items. Now we don't go to mall to buy lifestyle items. We go to a supermarket to buy daily essentials. We eat less food outside in the restaurants, and we eat more at home. So what we do, when the restaurants don't use quality ingredients, but when you cook food at home, you buy quality ingredients. So the quality, those companies like Hindustan Lever, Nestle, branded companies, their consumption is, their demand is going to go more. Restaurants don't buy branded ingredients, correct? They buy from substandard. So there's a that changes are happening everywhere, and you will see a lot of importance given to quality on our daily essentials now. So this trend we are going to see, and this behavior changes permanent now, at least for next 2-3 years. The other thing which we are seeing is surge in digital payments. As I've been saying in my last webinar and everywhere, that paying hard currency, cash, had a limitations. So it can have a virus. In America, nobody is accepting cash payments. Everything has to be digital, cashless payment, because there may be a virus. They don't even touch your credit cards. You have to pay by phone, or you have to scan your credit card on your own. So that same trend is going to happen in India, correct? So more and more digital payments going to happen. So you need to invest, your portfolio should have a higher allocation to this kind of a company. Now, consumer spending habits have, I went backwards, sorry about that. Then rise in how we watch entertainment, correct? Previously, we used to go to watch games, we used to go to theaters, all that has stopped, and we are now watching everything on streaming. We watch movies on phone, on our iPad, on our computers, and on television. So cable, now all this online viewership has increased disproportionately, and these companies are going to do very well, and there is going to be increased demand for content and quality streaming services. So invest in those companies, and you should be doing fine there. Then increase on online shopping. Now, during this coronavirus thing, companies like Amazon, companies like Target in America, Superstore, they saw 300% increase in shopping online. So that kind of 200 and 300%. Amazon hired 1 lakh people, whereas other companies were laying off during the month of February and March, correct? and they were hiring, they were ramping up people, and so online shopping has increased drastically, and this trend is going to continue for some time, and this is going to have an impact on real estate, as we all know that. So your portfolio has to have a proper structure on that. So you need to have a proper vision and structuring that, correct? You build a vision, and that. Then next comes personality. Now personality, what kind of personality you have? If you have a pessimistic or fearful personality, if you fear or you're pessimistic, you can never create wealth. Because going forward, fixed deposit interest rates are going to go down. Let me give an example. In US, fixed deposit interest rates are practically zero. Now, even bond yields are less than 1%. So, do you expect bond markets to do well? No. Bond markets have peaked out, correct? So the more allocation has to go to the equity. Now, so if you're fearful and pessimistic, you may not be able to get returns. In India also, fixed deposit rates are going to go down. See, today, India gives 6 to 7% interest rates, and loans are at 10%. So it's a very big disadvantage to start a business in India. A person in Germany, Japan, America, anywhere can get a loan at 2 and 3%, and he can set up a business. So manufacturing plant. If I have to put a manufacturing plant in India, I have to take a loan at 10%. Why I would do that? It's very expensive. Why I would take a loan at 10%? I'll go bankrupt. So my manufacturing cost and product goes up, correct? So to revive the Indian economy, fixed deposit interest rates have to come down, and they will come down. We expect 1% reduction in the RBI rate in the next few days. So that's going to be a booster. Now, otherwise all banks will go bankrupt, correct? Which, if they have to give high interest rates on deposits, how they'll sustain? Nobody is going to take a loan at 10%. I'm not going to take it. So from where they're going to pay 6-7% interest? So if you're fearful and pessimistic, your returns in the future are going to be less. Then people have biases. People are if you analyze the information too much, you take a lot of time. It's not going to help. It's over analysis sometimes is a distraction, correct? Then slow decision maker, then over optimistic. So I have seen this kind of personalities getting less return, but those who are rational, logical, and optimistic. I'm not saying over optimistic. Optimistic, they get the best returns. I have seen that. I give the same investments to all the clients, but the last kind of personality gets the highest return than this, because those who check their portfolios every day, they will not make money. Those who check the portfolio once in a quarter, they will make better returns than those who check every day. So these are some of the traits you have to see how you behave, correct? Then now I'll give you another example, more examples on personality. Types of investor personalities, correct? So I have classified here based on my experience. There are extreme people who are day traders who they want to invest in the morning and sell in the evening, or trade in the market, or people who are extremely fearful and keep all the money in fixed deposits. Why they do that? Because they're extremely possessive of their investments. Oh, this is my money, I need to control, I need to have constant on that. They get the least returned. Then leverage investors, people who take money on their investments and loans and invest in the stock market or anywhere, margin traders, they get slightly higher return than the first kind of personality. But then do-it-yourself investors, people who watch, like to play the market, they think they know everything. You can't be a doctor without going to college, correct? Can you be a doctor? Can you be an engineer? Can you be a scientist? So to be a good investor, you can't do that by just reading a book or discussing with your friends, and it's not possible. That education is going to be very expensive. To be a savvy investor means it's like being a fund manager. It's a very expensive thing. And then short-term traders, those who buy today and sell next week, and who think that they'll make money 2-3 times and the fourth time they lose a lot of money. So short-term traders, then momentum, correct? Momentum investors, those who flow, correct? Oh, just now this sector is moving up, I get into that and ride that. But they don't have a proper asset allocation strategy. They are momentum. Whatever is the flavor of the month, they'll invest there. Long-term random investors, correct? Investors who invest for long term but randomly. They make slightly higher return than the other categories, but they are good investors, but they are unorganized. So they have more than 20, 30 long-term investments. But they're all random, correct? There is no proper allocations to that. Then long-term with multiple advisors and confused. Now, okay, we do either be engineer, doctor or science. We focus, correct? We don't say I'm going to be engineer and doctor at the same time because I don't want to take risk. Now, in the same way in investments, you need to work with one advisor on one platform. But I've seen in developed economy, I see that in emerging economies, people have multiple advisors because they think the advisors are not good, or mutual fund companies are not good, or stockbrokers are not good, and they don't trust them. And when you have multiple accounts, on the long term, you will suffer leakages and you will find it difficult to manage, and you won't have a comprehensive strategy. Means you're sacrificing your strategy because of your lack of trust on someone. So that's going to affect your investments, and it will create more confusion. Because let's say if I'm consulting 3 physicians, and I'll get more confused than the physicians, correct? So what I need to do is identify one person and ask a lot of questions, build a trust and work with that. Same thing. Then long term with quality. They are quality conscious but less process driven. So they have identified good investments, but they don't follow the process. They randomly invest. They try to time the market. They are the second best investors, and the most successful investors so I've been in this field for 40 years. I said, which class of my clients made the most money? I give the same advice to everyone. The clients who have strategic, logical and process driven. We meet once in a quarter, we discuss very in detail, work out the concerns and invest, and then follow the process. They have made most of the money, and every investment goes through a bad time and a good time. Like every friendship, every business, every relation goes through bad times and a good times. You have to work on it, and if you stick to it, eventually you get good results. So this is what I have seen. So if you see this first category, they always lose. They'll never create wealth. This category will make sometimes, and this will most of the times they'll make the money. So we try to take clients from year to year. We work on the clients and we tell them very openly what's wrong. It's not only the market, it's your behavior also gives you money. Then what are right and wrong things in investments? Okay, so those who invest this is again related to personalities, correct? How you think. So those who invest in the bear market, slightly higher, but they will make more returns than those who invest in the bull market. So I'll give you an example. In the month of February, March, when the markets were going down, most of the investors must be thinking, okay, should I sell? Should I sell? Should I sell? Correct? That was the time to invest. And when the markets are going up, now they want to put more money. So if you invest in the bull market, you have already lost the huge upside which happened in the bear market, when the market moved from the bear market to the bull market. So the best time, you need to invest more in a bear market than a bull market. Now currently the markets have recovered sharply in US. In India they have not that yet recovered. You will see a lag effect of that in the coming few months, correct? So in India is still in the bear market. Nasdaq is already coming to the bull market, and then trends, correct? Those who follow trends and those who follow events. Those who follow events, they defer the investments and they panic, correct? They panic. Those who follow trends, they follow a process, they make more money. Then process driven random, correct? Ad hoc and random. So ad hoc person, like you eat food anytime during the day, every day. Or those who eat food exactly at 12 o'clock every day and at 6 p.m. every day, that's a process driven. They are more healthy than those who eat randomly. Same thing about investments. Process driven people always make more money. Now I'll give you another example. Those who are process driven, their SIPs would give very high return in the bear market, correct? So you top up your SIPs in the bear market, you don't top up your SIPs in the bull market. The other thing, those who invest in growth stocks and value stocks, the value stocks have not worked for last 15 years. Last 15 years, the growth stocks have worked, or last 15 to 20 years. Now, what are growth stocks? So, Hindustan Lever is a growth stock, correct? You take Amazon. Now, I'll give you another classic example, Uber. Uber came out with the quarterly results 2 days back. It made the losses in first 3 months of this year of $2.5 billion. The losses was $2.5 billion, and the stock went up by 15% in last 2 days. Why? Because it's a growth stock and it's changing the way food gets delivered to us, and the changing the way we commute. And Uber is not going anywhere. It's same thing like Amazon. Amazon made huge losses for first 15 years, and today Amazon is one of the most profitable, dominated company in the world. So these are growth stocks. Now these growth stocks, when they mature, they become value stocks. So every company goes through the phases. Now so Tata Steel is a value stock. L&T is a value stock. So they have mature companies. Mature companies give less return, whereas the growth stocks give higher return when they're in the growth phase. So you need to have a proper allocation now between these two categories. And most of the people always go by historical return, correct? And when you go by historical return, most of the times you go by value stocks. Now, Warren Buffett has underperformed for last 15 to 20 years because he is a growth stock guy. He's a value guy, correct? He invests in Coca-Cola. He'll invest in companies which have very good book value, high dividend yield, and that kind of stuff. Now, how many, if you have invested in PSU banks, how many of you, all of us have made money? No, we have incurred losses. So they are value stocks. So value stocks are not in fashion. Growth stocks are in fashion. In the next 5 to 10 years, still growth stocks will keep performing. Then next you see your investments are futuristic, not for past. This should be bear market, past returns, not bull market. Here it should be past returns here. There's a spelling error here. Then you should be more higher weight in large cap than small cap. Then you should invest everything on a single platform than multiple platform. If you have stockbroking account with 5 different brokers, it's not a good thing. You'll never be able to implement your strategy because you should have everything at one place. So, and use simple portfolio than a complex portfolio. Like complex portfolio has derivatives, lock-in investment, PMS. You should not have a complex portfolio. You should have a simple. So these are right and wrong things, this are all personality driven, how you think, correct? Then the other thing, the less number of items, you are better, correct? Like God has given us only 2 legs, 2 hands. Imagine you had 20 legs. You would not be able to move fast, correct? So the less number of items and the quality items you have, you are better off. Like, our grandparents used to have 7, 8 kids. Now we have only 2 kids. So same thing in your investments, but they're quality kids, correct? We focus on them. Same thing in your investments. The less you have, the better quality you'll get. The more the number of items you have, your quality will deteriorate because you are randomly investing. So that is the other focus you should do. Timing, people try to, investing in bear market or recovery phase always gives you maximum return. So just now Indian markets it's still in the bear market, it has not moved to recovery. So as it moves to recovery and bear market phase, imagine those who invested in 2008-9. It doesn't matter whether you invested in June or December or you got very good returns, correct? Very good returns. Imagine those who invested in 2007 when there was a bull market in India. They got killed, correct? So you need, in 2007, if you had seen the past returns of any mutual fund, they would have given 25-30% per annum compounded. And you looked at those fact sheets and you invested and you got killed in next year. Now, those who saw the fact sheets in 2008 or 9, returns are negative -20 for this year, and you still invested, they made a killing. So investing in a bear market is very important. As I said, in the bull market last phase, maximum people try to invest. Avoid that. So timing is, you have to follow a process. The other thing which I have noticed, wealth creation, you need to go through a complete cycle. Okay, coming back to timing again, those who go by momentum, they'll make money in the short term, but in the long term, you'll see they'll go like this, correct? But those who follow a process, they'll make less money in the beginning, but eventually they'll make more money. So this is the process you have to follow, strategy focused investments. And this is our experience. The world is not going to end, the world is going to grow, the world is going to innovate, science is going to improve. So we need to be optimistic and invest, correct? Now, process of investments. This counts 25% of your. If you follow a process, it will take a lot of risk from market timing. It will take a lot of risk on your personality behavior, and it will support your strategy and this. So number of items should be, quality should be good. Number of items should be less, and SIPs should be there. And once every 2 years, or you should rebalance your portfolio. You should not rebalance your portfolio. Clients keep on asking me every month, should I rebalance your portfolio? No, you should not rebalance your portfolio every month. It should be done over a period of time, not very frequently. Now, people like to change the investments very frequent. So I'll show you one small, when you reshuffle your portfolio very fast, what happens? I'll show you a video, small 20 seconds video here. What happens when you try to reshuffle your portfolio? Like you're standing in queue. This is portfolio A, this is portfolio A, and this is portfolio B, or mutual fund A and B, and this is you. You think B is good, and you see A going up, so you move to A. When you move to A, B moves up. Fund B is not moving, so he moves to fund A. Now fund B starts moving. Eventually he's a loser, correct? So that's what happens when you shuffle your portfolio too fast, or avoid that, correct? So this is also one of the process. So the other thing, you need to have conviction in what you are doing. Conviction is the most important thing in life. Anything what you do, whatever profession you are, you have to have confidence and conviction of what you are doing, and that takes you to a next level. Same thing about investments. Invest with conviction, ask a lot of questions, analyze it, I'm fine, and then build a conviction. And once you get a conviction, stick with it. You will make more return. Those who shuffle the portfolio, it doesn't work out very good. Then there's strategic thing. So just I'm summarizing thing. A very good strategic investor is forward-looking, quality-driven, logical thinker, and he has a plan. What happens if plan A doesn't work? So that's rebalancing your portfolio, correct? So this is the way you work, and this kind of clients make a lot of money over a period of time, and they can navigate through any challenges. Now, as I said, the key is proper diversification. Diversification not only in India, globally, whenever I mean to say that. Now, I'll share with you a portfolio. I'm going to give you more examples here, but I'm giving you a portfolio which invested a large chunk of money in January 2020 this year. So imagine before the corona came and markets were at all-time high in January, and what happened? So we invested, and even today that portfolio is giving us a 11% return because we had a proper diversification globally, we had a proper allocation, and we followed a process, regular investments. So we invested in the month of Jan, we invested in the month of Feb, we invested in the month of March and in April. So it averaged out and markets was volatile. See what happened. The US bounced the first, correct? So they gave the highest return. Indian healthcare, pharma bounced back 25% in just last 1 month. The entire return came from, so see the returns we got here, correct? The banking has gone down. Now, but you continue investing. We are continuing in, without banking sector, Indian economy can't come up, correct? What technology is to America, banking is to India. Banking is where maximum digitalization is going to happen. So you need to continue investing in that and rebalance the portfolio. Now, this is of portfolio which was opened in 2020. Now you will ask me what happened to portfolios which came to us in 2018 and 19. Yes, 2018 and 19, those portfolios which have come to us, they are giving returns between plus 4% to minus 10 to 12%. Now, portfolios which have come prior to 2017 and 16, they are giving positive returns. So what happens is you have to go through one complete economic cycle to build your portfolio. If you're going to check your returns every day, every month, and compare with the bank FD, it doesn't work out. So in life, there are certain things long term, correct? Investments in your kid is a long term. You don't keep bugging them every day. Investing in your spouse is a long term. So investing in your portfolio, wealth creation is also long term. You can't keep on comparing every day. If you do that, it doesn't create. Now, how many times you keep on checking your value of your house property, where you're staying? You don't do that. Now, property prices go down. Do you shuffle your property? No. Same thing about your investments. So you need to have a proper long-term strategy. And going forward, those who go through one complete economic cycle, they mature as an investor and they make very good money. Those who keep coming in and out of within the cycle period, they miss every cycle. And that's what my experience has been. Now, so what this coronavirus lockdown lessons teach us? Life costs very little, but we spend a lot of money on lifestyle. We need to spend more money on life, correct? Understand? Same way, investment otherwise costs very little, but it's our own behavior and decision that costs us a lot. Now, investment advice is very cheap, but if you try to do investments on your own in multiple platforms, you will spend more money on Howard education. Howard education will be very cheaper than the opportunities you have lost and the mistakes you have made. Yeah, so with this, what I'm summarizing is that if you really want to build a solid portfolio for your family, you need to have a strategy of investing globally and build a step-by-step process portfolio. Okay, so now I stop here, and my next week talk is going to be value versus growth investment, changing dynamics. So I'm going to give real life examples, what is happening in the value category and what's happening in the growth stocks. And I'll be doing that next week. And I'll take your questions now. Feel free to ask. And if you like today's webinar, and if you want to continue this, please subscribe to our channel and click on that bell here on your YouTube. Thank you very much. And now I'll take your questions. My first question is, okay, I won't take So we are going to consolidate some repetitive questions into one. I'll answer that way. And if we have missed anything, feel free to contact us, or we'll contact you and give one-to-one answers. Okay, thank you very much. So the first question is, do you fix a stop loss figure for the script that you invest and sell part of the holding if the price goes below that? And so we are portfolio builders. We are not stock traders, correct? We don't. Okay, again I'm saying, you want to build your portfolio. So let me ask you one thing. We identify a stock and we say, okay, I want to have Microsoft in my portfolio. I want to have Hindustan Lever in my portfolio. So I keep on buying that. Now, if I think something is wrong in that company, I'll exit totally. I won't put a stop loss. No, you don't build your portfolio like so. Like say you are doing your education, you want to be an engineer. In one of the semesters, you got less marks. So do you put a stop loss there? Okay, I'm going to quit engineering and now go to no. So these stop losses are trading strategies, not investing strategies. We don't put stop losses. We build the portfolio, and we are very selective on the stocks. Yeah. The next question is it possible for crypto or blockchain currency can take place in digital payments in near future in India? Very good question. At the same time, cryptocurrencies, a long way to go. I would invest in companies which are digitalizing more in the businesses, correct? I would do, in 2017, I believe, correct, blockchain cryptocurrency was very popular. A lot of people invested at 18,000, 19,000, and see what happened. They got killed. Yeah, had they invested in NASDAQ that time, they would have tripled the money. So why you want to go to those kind of fancy news driven item? I wouldn't go for that. I would go for simple. Yes, blockchain is here to stay. I'm not denying that. But I would invest in blockchain companies, companies which are using digital things more. Okay. Yeah. The next question is, you said the past don't repeat, but today all performing companies are large cap, Britannia, Hindustan Lever, who have less debt and zero debt. So how you differentiate that? Okay. So what I'm trying to say is past. Okay, I'm not talking about past about a company. I'm talking about uh, what do you call the sectors, or uh, when you're investing in a mutual fund and you see the past returns, correct, and you in a bull market the past returns looks very good, in a bear market past returns look very bad. So you are trying to make your decision based on past. So even if you take Hindustan Lever, okay, even in stock, correct, Hindustan Lever didn't perform for 10 years. I remember from 2002 to 2014, Hindustan Lever didn't perform. It was only a 250 rupees stock. It was totally underperforming. Then Reliance didn't perform for 10 years. It was only 800 to 1000 rupees stock. And in last 2 years, it has gone 2.5 times. So even stocks do that. You invest in good businesses and stick to it, correct? Yeah. Uh, Yeah, as we see, J. Crew's Gold Gem, Neiman Marcus went bankrupt in US in a week's time. In India, we can expect bankruptcy as well as the economy stand by. So how do we? Okay, good question. Now, the world is a ongoing thing, correct? The mother nature. Every day, new people are born, new babies are born, and many people, unfortunately, die, correct? So do we stop living? No. Same way, businesses, companies go bankrupt, new companies come up, correct? Inefficient companies go bankrupt. Yes, there are a lot of bankruptcies going to happen in India, America. A lot of bankruptcies are going to happen in next 2 years. that's a good sign of cleaning up, correct? Because they structured their project wrongly. Mm, you, there is nothing permanent in life, and only the fittest survive. So but that doesn't mean the growth doesn't happen, correct? The growth is going to happen. Hmm. Why only growth-based stocks? Isn't it more risky? In my personality is a bit fearful. How do I balance it out? Okay, very good question. So, if you take the history of the world, there is a period where value stocks work, and there was a period when growth stocks work. So growth stocks work when there is a disruption happening, technologies are changing. So between 1940 to the year 1990 or 95, value stocks worked, and that's when Warren Buffett became very rich. Now there was hardly any new innovations between 1940 till 1990. America was known by Coca-Cola, Pepsi drinks, and those kind of. The best company in the US was Coca-Cola that time, and oil companies. So there was no innovation in that. Then the PC computers brought the change. Microsoft got the change in the year 1990, and the world changed, correct? Steve Jobs and Bill Gates changed the world, the way we work today. So then the growth stocks came because they were disrupting every business. Then internet came, Amazon came, then Google came, and they're disrupting the old way of business. So let me put it this way. Our grandparents used to go to Marathi school or Gujarati school, whichever your mother tongue was. But we don't send our kids to those schools. We send them to English medium schools. Why do we send them to English medium schools? Because there is English medium school, because there is growth. They can work in India, America, anywhere in the world. If you put them in only Marathi medium schools, their growth is going to be limited, only for local. So that's a value stock. Now you tell me, you are fearful, correct? Now I have three sisters. My dad said the sisters are going to go for marriage, so I'm going to put them in Gujarati school, and my dad put me only in English school, in English medium. Now what happened today? I see very big disadvantage to that. My sisters, they are totally dependent on their spouses. They are not independent, and if something goes wrong, they can't take decisions in life. I don't want my daughter to go through that. I'm going to put her in English, and she's a doctor. I'm educating them. So growth stocks. The way the world is changing, economy is changing. So growth, there is nothing. Okay, there is always going to be volatility. So ocean has a volatility. When you fly the aeroplane, there is a volatility. But can you live without flying today? Now today, every airline company is bankrupt. But do you think airline industry is going to close down? If airline industry is going to close down, forget about any business doing well in the world. Forget about any business or profession you are doing. Your growth will be limited, correct? So this stocks will come back again. So same thing, the growth is going to come from technology, and that's why you need to invest in those kind of stocks. Value means what? Value means that it's a mature business, they are not going to grow. So when they are not going to grow, not many investors are going to come there. Now, yeah, my take is, you don't have to be fearful. You have to. So if you're fearful, you'll never fly. If you're fearful, you'll never go in a cruise or never go near on a beach, because ocean, correct? But without oceans, the world wouldn't exist. So you have to address how to manage the risk. But growth is the place to go. Okay. If I decide to invest in a pharma fund, does it signify that I am following the flavor of the season? Very good question. Okay. If you invest only in pharma, so you're handpicking a fund, correct? Randomly. You need to pick a basket. Okay. Going to have, out of my $100, you need to build a portfolio irrespective of what's moving or down. Next 15 years, what's going to happen in the world, and work backwards. And in that, the pharma place definitely has a a place in it. So like you're building a cricket team. So, Kohli is doing very good. So you pick up Kohli. Yeah, there's nothing wrong in it. But you need to pick up other 11 players also, 10 players also, correct? You can't win any match just with one player. And that's the problem I see in India. People like to choose and go after, randomly do one thing. And you need to have a proper basket, a balanced team. You need to have an opening batsman, middle order batsman. You need to have a good fast bowlers and spinners and build the portfolio. Then you win the match. Mhm. Okay, very good question. Warren Buffett has made money for all these years. Many people do not give him an example when comes to investing. So why do you feel that value stocks and not make money here onwards? Okay, Warren Buffett made money. That's a true. He made the highest money in 1954. Not in last 20 years. He's underperforming. Now, Warren Buffett didn't create any companies. He does a capital allocation, correct? He didn't innovate. So, Steve Jobs, Bill Gates, you know, they created all these companies from zero capital. So they created more wealth than Warren Buffett. What I'm saying is the technologies and the future has not been created by Warren Buffett. He made money. So it's like this. In Islam, it's considered to be unethical by keeping money in fixed deposits. Why? Because they say you don't work. It's a haram. You suck the blood of other people's hard work. So you should not. You should put your money to hard work. You should create an economy. Same thing, the concept is Warren Buffett is lending money. He is a money lender, correct? And he's paying safe. He's not creating an asset class. I'm not saying it's wrong or right. What I'm trying to say is more money will be created by growth class assets than Warren Buffett kind of people going forward. Warren Buffett concepts will work very well when innovation stops and you have to work within whatever we have. That time the value stocks will work. What is your view on gold? Can I have equal and opposite allocation to gold? You should not have more than 5% allocation to gold, not equal. And again, I'm saying you don't jump into any asset class because now it's the flavor of the year. Yes, gold is the flavor of the. It should be over a gradual period of time, whether good times or bad times. The same allocation should be there to gold as a hedge against insurance. Yes. FMGC stocks can be called growth stocks. Not all FMCG stocks, a few FMG stocks can be called growth stocks. Growth stocks are stocks which keep on capturing new markets and innovating. And they have a very high PE. That's why they are called growth stocks. And eventually when their growth expanding stops and they mature, see like ITC is not a growth stock. It's a value stock. And that's why it's currently underperforming the market, correct? Now, when you don't innovate or you can't create new products, your growth stops and you have to manage within the same economy and same market. That's where you stop, correct? So not all FMG stocks, companies which are innovating their products, they can be called growth stocks and there are very few of them. My question is, volatile market, should we focus on technical analysis or fundamental or both? Short-term investments? No. Okay. As I said, if you want to be a stock trader, then you follow technical and fundamental and play. Then you don't focus on your career, correct? Now, if I'm a doctor, I'll focus on my profession. If I'm an engineer, I'll focus on my profession. And whatever money I save, I will invest regularly. I won't follow a technical or fundamental. So, when I was working for a corporate, I used to save every month. On the 5th of every month, my paycheck, the money used to go in my retirement corpus, and I never bothered to time the market, correct? Now, when the company gave me a job to manage my employees' pension fund, then I started evaluating the mutual fund market and stock markets and all that. And then I used to take into consideration the technicals and fundamentals for the benefit of my client. I never used to tell the client the technical stuff and time the market, but technicals guide me to the right fundamental companies. I wouldn't trade on technicals. I wouldn't. My objective is to build a portfolio on a long-term basis. Correct. So that's the way I would do it. And in India, what I've seen, for every one investor, there are 9 people who are speculators. In America, for every 9 investors, there is one who is a speculator. So in India is a very large proportion. There is too much focus given in media on papers, on technical analysis, so people think that's the way out. No, that's not the way out. You can't create wealth using technical analysis. You can never do that. You have to follow a process and fundamental analysis and work on a strategy. Since growth stocks depend on demand, what will be their situation if the demand doesn't pick up due to worsening of the virus situation? Very good question. Okay, so let me ask you one thing. Growth stocks, what are the growth stocks today? Technology stocks, healthcare stocks, correct? Who are innovating. So do you think growth, Amazon, there is no growth, Microsoft, there is no growth? I was just watching a news report recently, and last month a survey was taken from all the CEOs of Fortune 500 company, where you're going to cut your expenses the most. So they said capital project, they are going to cut the expenses the most. So creating new projects, and they were asked where you're going to spend the most. All the Fortune 500 companies, CEOs said they're going to increase their spending on information technology. I'm going to invest more in digitalization so I can do more, because work from home, this thing happened, correct? Every company was caught off guard. So every company is investing more on digitalization, more on how you can do business remotely. And so there are growth stocks, correct? So demand is going to be there. Demand is going to explode there. So there are certain sectors. Now demand is not going to, so it doesn't happen that demand, there is a disruption because of the coronavirus, but demand has not gone down everywhere. So what happened in the first week when the lockdown happened? In America, toilet papers went out of order, correct? Then hand sanitizer stock was not there. In the second week, what happened? Groceries went out of stock. People started buying more. Now today, if you see, since saloons are closed, people are buying all the stock of hair cutting and all that kind of stuff is not there. It's sold out. Now then what else is not there today? So the demand goes up. In certain section, the demand is always going to come back. Now they say that in India, the demand for two-wheelers is going to shoot up after opening. This happened. People, instead of going by bus or public transport, will go on a two-wheeler. Everybody can't afford to buy a car. So same way, there is going to be demand. People are not going to sit for all 365 days at home. Demand is going to come back, and it'll come in different rotations, correct? Different sectors, different time. Yeah. I hope I've answered most of the questions, and I end my session today. And thank you very much. I appreciate for your time, and do give us a feedback and subscribe to our channel. And I look forward to talk to you on next Saturday. Thank you very much. Thank you.